So what should we believe? The drop we had yesterday or the bounce that we had today? So I'm going to tell you which one that we should believe and why and where we might be going from here. I'm also going to tell you some sectors that we have been doing well and how there might be some rotation from winners into other sectors where there might be some value and how we can trade that rotation, take advantage. Let's go ahead and get started. Today is Wednesday, May the 30th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching us tonight. Welcome to those of you who found us, watching us for the first time. Keep coming back for more day after day. Subscribe to our YouTube channel by mousing over the logo in the bottom right corner of this video, and then click the red subscribe button that pops up. Also, click the thumbs up icon that's down below this video. That tells me two things. Number one, you like the video, you got something out of it tonight. Number two, you want us to do this video again tomorrow. And so that one click will give us feedback, tell us what you're thinking, and tell us whether it's worth it for you all for us to keep doing these videos day after day. Comment on anything that stands out to you from today's video. Love to hear your thoughts. You have to scroll down further to do that. Join the daily Market Outlook email list. You'll see there's a link in the video description below to be able to do that. Follow me on Twitter for more content like this throughout the day, throughout the week. You'll see my handle up on the screen here at DavidSettle42. Like and retweet tonight's Market Outlook tweet. That will tell Twitter to keep pushing you all of our content from me, from Brandon, from Market Scholars. Also, join our Market Outlook community on Facebook. There's an address, again, at the top left corner of your screen here. There's also a link in the video description that will take you there too. All right, let's take a look at the S&P 500 first with the market forecast indicator. You can see maintaining a strong bullish posture with yesterday's drop out of that 2-week range, and then today's move right back up into the middle of last week's 2-week range. So and again, we closed before the weekend at 27.21.33. We closed today at 27.24.01. So, again, just basically completely reversing what happened yesterday, as if nothing ever happened, which, in my class that we taught yesterday on directional option strategies, that was kind of the idea, like, no big deal, right? This pullback, while, it is a pullback, and there's a variety of reasons why not to take it too seriously, as we can see from today's action. The posture is still strongly bullish because the intermediate line is still above 80. And so we still have a strong green pattern here, persisting here. Intermediate line's rising, now finally getting into the 41st percentile after being kind of stuck in the 40th or around the 40th percentile for so many days in a row. There's a few times that briefly got up above 41. As you can see the numbers over here on the left. So you can see we're right around the 40th percentile for so long. And then finally today getting up above 41 into the 41.75, almost a 42nd percentile. So rising market sentiment, but still not above 50, which is what it needs to get in order to look like this, right? You can see the Russell 2000 looking really, really good. Its market sentiment line is above 50. So, since this posture started, the strong bullish posture started back here on May the 3rd, there's only been 5 days, down days. 5 days. And from May the 3rd on, the Russell 2000 has gone from 1540, it's gained 100 points, 1546 to 1647 since May the 3rd. Since May the 3rd on the S&P 500, here we are here, we've also gone up from 26.29 to 27.24, so about another 100 points. Now, not as big of a move as it was on the Russell, because the Russell, remember, is at 1,500, so not as big a percentage move, but still about 100 points. But you can see all the down days that it's had, 1, 2, 3, 4, 5, 6, 7, 8. There's the 8th day right there. You can see it's barely red. So 8 down days, whereas only 5 on the Russell. That's what happens. And you can see how sideways we were when you have market sentiment below 50 versus having market sentiment above 50, where we're easily, no sideways trading range, easily above the moving average, and continuing to push up to new all-time highs, and came very, very close to an overbought cluster today. Now, overbought clusters can occur early on in a bullish period. You can see we turned bullish here with a move above 50. We got a bullish cluster right away. And then we kind of went weekly bearish here and turned back to being bullish. And so basically, this was still one big intermediate run. So we had multiple clusters, 5 of them during this intermediate run. And we had one right off the bat. So would not have been a bad thing to get one here. Even though now, I mean, this is kind of lightly shaded green areas over here. The intermediate rally started back here when we crossed above 50 on the intermediate line. So this is one big bullish intermediate rally. So we're, that was April the 16th. So we're, a week and a half or a month and a half into this intermediate rally, and it typically lasts 1 to 3 months. And we were expecting a little bit longer because of how low market sentiment is, especially for something like the S&P 500. The S&P 500, unlike the Russell, its intermediate line did pull back down below 50. So kind of a separate, brief little intermediate rally right there, which wasn't much of anything because we were on a downward trend, and then this is really the beginning. So it started here May the 7th, so we're only 3 weeks into it. We're not even a month yet into it on the S&P 500. Closing above the high to low day, if you want to count this sideways action as a pullback. Closing above the high to low day, it's yesterday being the low day, the day with the lowest low, and obviously closing above yesterday's high today. Momentum line spiking back up in the reversal zone. The near-term line bouncing back up from not necessarily a bullish near-term high because it is a lower high point, a lower low, excuse me. It's not considered a bullish near-term low because it is a lower low on the index instead of being a higher low. This bottom here associated with this low is lower than the one associated with that low. But, they're not bearish lows either because it didn't drop into the reversal zone. It was lower, but it didn't drop in the reversal zone, so not as bearish as it could be. And, of course, bouncing back up above 50. Now, that was a bearish high point because we were unable to get the higher highs, and we didn't get above 80. So we haven't really been able to solidify this trend because of where market sentiment is. So we'll see if the near-term line can make its way up into the reversal zone like it almost has here. Where is it? How come I'm not getting into, let's see, the Russell 2000. Here we go. Like it almost has here. And it did get up above 80 on that near-term rally. And you can see that is a bullish near-term low point because also did not get about below 20, but it did form a higher low. So you can see the near-term pullbacks, the short-term pullbacks. We go up, we get a short-term pullback. We go up, we get a short-term pullback, and now, so far, starting a new bullish near-term wave higher here. You can look at the other indexes, NASDAQ Composite, strong bullish posture, breaking above, breaking to the outside of this sideways range a little bit here. A momentum line jumping higher too, and then finally the Dow Jones Industrial Average still showing a weak bearish posture. Nothing to change the trend. You can see still an intermediate rally. It's a light pink area. When it gets to dark pink, that's when we know we finished. So we haven't got the dark pink. Still light pink because we're not below 50. We can turn back up and be right back to a strong bullish posture just like that. Near-term line still hasn't crossed above 50. So still the weakest out of all the major indexes, the Dow Jones actually continues to be the weakest. Its market sentiment lower than the S&Ps, but at least rising and starting to make some headway up to the, and you can see it's got a longer basing action here to break out of and not anywhere close to its all-time highs. And you can see the S&P 500, same thing. It's got to break up above these highs. Starting, it's breaking out more than the Dow has, but not breaking the all-time highs like the Russell 2000 has, definitely. But it's a good thing that this is what's leading the market higher. It's a good thing that small caps are typically a riskier asset class, is leading large caps, typically more of a safe haven asset class. When you're looking to be bullish, you're typically looking to be bullish safely in that large cap index. You're looking for return that companies, a higher risk of return when you're buying the small cap index. All right, just take a quick pause here and remind you, for those who are watching on the Market Scholars blog, here you can see the video that's always embedded here. If you're watching us here, remember you have all the YouTube video controls in the bottom right corner. And this little eye in the top right of the video will show you the links to subscribe to our site, get to the blog, for those of you who are watching the video on YouTube, and then of course our poll tonight, and then the link to discuss the video in the forums here. It's all, again, with the I button in the top right corner of your screen. Remember to do these 3 clicks to tell us you want us to do the video again. And that is, 1, here on Twitter, for those who have a Twitter account, click that like button there. Those of you who have Facebook accounts, which I believe is a lot more than what we're seeing here, clicking there. Again, this is all embedded on this post, and of course, this green button here. And remember, if you haven't already joined our daily Market Outlook email list, here's a way you can do it too. Just click in your first name, last name, your email address, and click the orange button here to sign up. When you look at the long-term charts, yesterday getting below the 50-day moving average, getting back above it today, and still rising. The 50-day moving average is rising. The 200-day moving average is rising. We're still up above both. So still bullish from the long-term viewpoint. Bullish in the intermediate posture, as we saw with the market forecast, as well as we look at the 3 green arrows here. We're back to 1 green arrow, so we're not shaded pink anymore. That was temporary when we had the 3 red arrows. Now we don't have 3 red arrows again, so no shading, and we'll have to get that MACD and stochastics back to being bullish before we get the green shading again. But you can see back up above after testing the 30-day moving average, which typically leads to convergence when we do that yesterday, back up above the 8-day moving average, just like that. So we'll see, if yesterday was just a blip or if it's going to lead to more of a convergence. We'll see if this market sentiment turns back up now, which is starting to do, gets back up above the moving average, and how high it gets. I can definitely see it, considering we're just starting this intermediate trend, getting back up to this 20 area for a second time, something similar, even to like right here. And we've compared this to over here, even though this one didn't pull all the way to the 30-day moving average. In this particular case, the MACD got only up to about 13 before pulling back down a little bit below its moving average and getting back up to a new higher high, about 16. So here we're already up to about that 16 area. We'll see if we bounce back up to a higher high around 20, with a new renewed bullish push. When you look at the intraday move, so we saw bullish in the long-term trend, bullish in the intermediate trend, getting more bullish in the intermediate trend through the market forecast and the 3 green arrows. On the short-term trend, you can see how yesterday's moves was bearish. It broke below last week's range, but stayed in the upper half of the 4-week range. Well, just like that, today breaking back up into last week's range. So, we're not getting new 4-week high points yet, but we're also not threatening the lower half of the chart either anymore as we bounce right back up. You can see getting, eventually in a couple more days, this is going to move up. So this line will move up too, and I wouldn't be surprised if it moved up to right around there. You can see this 267 and 3/4 is the low point from yesterday, but there's also multiple touches over here too on an intraday basis. That's probably where, as we move up this line, that this dotted line will move up. The dotted line being the midpoint of the 4-week range. As long as we're trading in the upper half of that range, things are okay. It's when we get to the lower half, if we haven't broken below the low yet, that's when you start to worry about it breaking below the low and starting a bearish trend. If you take a look at today's range, the volume yesterday got up to above 1.5 times the average volume. So some pretty heavy volume. Today back down and back to about where the average is, and you can see what the average is doing. The trading range was, let's go back to the market forecast chart here. You can see for the S&P 500, just a smidgen below the average for the trading range. So whenever I look at this is the 1%. This actually, I need to move this. Yeah, that's the 1% mark here. We're still a little bit above 1% on the ATR relative to the price. Relative to the price of the stock. So we're still relatively high, but you can see we've come down from 2%, which is where it was, almost 2%. So we've almost cut it in half, and you can see we can get down as low as a third or half, less than half of 1% of the actual price of the stock. That's when you know we're pretty bullish. So we haven't broken below that yet, but you can see the trend is definitely down on both of these. And of course, when you look at the volatility index, you can see the VIX spiked up yesterday. It didn't quite get up above 20, but it got up to the spike in volatility we had at the beginning of the month. Here, I'll show you what that looks like there. So there was the spike on May the 3rd right there. So on an intraday basis, we got as high, now coming back, potentially back down below 15. So like I said, it's going to have a hard time getting below 12.5 on the volatility index. And you can see on a relative basis yesterday, we got up to the bearish territory. We blew right through the neutral zone there in the, we blew right through the neutral zone, which is in between 90 and 95%. So we started the day in bearish territory and got up to an extreme on an intraday basis before pulling back. And when you get extreme spikes in volatility, like we've seen before here at the end of April, we tend to pull back. And again, to see, that was back on April the 24th, beginning of the 25th when volatility was that high, just to kind of give you an idea. Let's see here. Oops, no, not that one, sorry. This one is what I wanted to show you. From April 24th to 25th, so there is the 24th. There's the spike in volatility we had, and you can see, we retested on the 3rd. That was that last time on an intraday basis, we spiked in volatility. And you can see we're actually higher now than we were then when VIX got to a similar level on an intraday basis like we did today. So again, another sign that we're not as bearish, that yesterday's move was not as bearish as it seemed to be. So to summarize, the posture is strongly bullish still on the S&P 500. A little bit of weakness yesterday, but eradicated today with today's bounce. So it shows how short-lived it was. Near-term lines bouncing. We're still not established in this trend yet because of where market sentiment is. You can see on the chart. But the bias right now is to the upside, especially with leaders being those small, with the riskier asset classes. So that's our posture right now is to the upside, barring anything unexpected news-wise that obviously has a longer effect than just a single day, like we saw with the news coming out of Italy. So what do you think? Do you agree or do you disagree? There's a poll popping out in the top right corner of your screen there. Tell me what you think. And of course, if you click on disagree, scroll down to the bottom, comment on what you're seeing. And maybe you see something different I haven't brought up. Let us know why you might not have that bias to the upside right now. All right, now if we take a look at what's driving the price action today, we had a few things come out from a news standpoint. Of course, the Beige Book came out. This is the data that's used in the Fed's FOMC meetings. You can see that things are looking okay, enough to keep the odds right here, the odds of a rate hike in June, relatively high. Not as high as they've been. A month ago we were at 95, close to 95% odds of a rate hike in June, and we're still at 88%. So, the odds have gone from 0% from not having a rate hike in June to now 11. So, there's a chance, but very, very low chance that we don't get the rate hike in June. Most likely going to get that. What's really been moving is the December. So again, March, June, September, December, having a rate hike every quarter is kind of the pattern. And you can see that the odds a month ago, when there was no odds, the 0% chance that we wouldn't get a rate hike in June, the odds of getting that fourth rate hike in December for the calendar year were pretty darn high. They were up to, 46%. Nearly 50% here when you add everything up. Nearly 50% odds that we would get, the second one. This is the current one, the one in March, June, September, and December. Well, now you can see the odds for a rate hike in December have fallen all the way down to about 25% combined rate hike that we'd get that we get the fourth one for the year. So now a low probability. Now we're looking more at just 3 for the calendar year. And you can see here So here's March, this would be June. We got about a 50-50 chance that we'll get the third rate hike in September. So right now the market's pricing in either September or December for that third rate hike, but not a good chance of getting 4 anymore, where we were pretty priced in for 4. I mean, to have a 50% chance of a rate hike by the end of the year, at the beginning of the year, those are pretty decent odds, considering it's a lot of time for things to change. And people are pricing in those odds here by buying or selling these futures contracts. So those are pretty high odds for as far away as that was, knowing that anything can change between now and December. The odds are dropping significantly for that. So you can see, and that's a reflection of what's going on with the economic indicators. At the beginning of the year, things were looking a lot more bullish, but in Europe and now kind of here in the U.S., the economic indicators have not been as bullish as they've been, and we see that today with the ADP employment report, kind of getting a second soft data point of sub 200,000 jobs reports. And you can see we had that last quarter too, last month, and that led to a soft number in the BLS total as well, which includes public and private. So a big drop or a big softening in these economic indicators. GDP also came out. The revision of GDP came out. There's the prior number revised slightly lower. And again, the site I like to use here, for those who aren't familiar with these videos, consumerindexes.com has a good breakdown of the GDP and the changes in the GDP. Get a little summary here of the changes that went on today, but coming down basically to 2.17%. And the things that jump out to you, the strength of the reports coming from a improvement in imports, so it's not as big of a negative, which means we're not importing as much, not necessarily the most bullish sign there from an economic standpoint. We're not we're not also selling as much from what we did last quarter either, but that's the biggest drop off there, is a negative growth in consumer goods sales and a softening in consumer services. That's a big part, this consumer element. It's one thing for inventories to grow. That's very temporary and a very small portion of economic growth. The much bigger portion is these 2 points put together. And this fixed investment includes more than just inventory growth. It also includes construction, residential construction, private, commercial construction, things like that. Of course, government spending's in there too. Is similar to the fixed investment, growing at a much smaller pace. You don't want the economy to depend upon that anyway. But that's your big one. And the fact that consumer goods is negative for the first time in the last few years, it's a little concerning from an economic growth standpoint. Now, remember, for going forward, the economic growth is still maintaining a pretty healthy 4% estimate for the next quarter going forward. So, again, we haven't had 4% growth for quite a while either. Now, I don't expect it to stay at 4%. The trend is typically to come down. But even coming back down to 3% would be kind of where we were for a few of the quarters last year. So it's not like this is like, oh no, now we're heading into recession. Hardly the case. But things are softening as we see. But today, not showing up today. In fact, if you look at the different asset classes here, you can see crude oil making a big bounce higher today. As long as your equity asset classes, small cap stocks here in pink, outpacing large cap stocks. But developed markets here in orange outpacing emerging markets, so not the most risk on there. But crude oil outpacing gold, the dollar dropping, and bonds dropping, and gold underperforming, high yield outpacing treasuries. So from all that, those are all risk on moves. That's a good sign when you consider, during this little pullback that we had in stock, that really, most of it was yesterday, but we had a little bit of a selling on Friday. But if you look at the pullback that we had from Friday's close through the holiday weekend, Tuesday, and into today, you can see that emerging markets were the biggest loser, including developed markets. That's where a lot of the issues were in Italy. They're still lagging behind, but you can see how small caps did not drop very much yesterday, not nearly as much. Crude oil, which was a big loser too, bouncing up sharply here. And of course, treasuries, which had rallied significantly yesterday as people selling European bonds coming back into the U.S., rallying significantly yesterday, not pulling back nearly as much. So through the pullback and subsequent bounce, you can see long-term treasury is still the best performing asset class so far this week, along with small cap stocks, which you really wouldn't put those two together most times in emerging markets. Not developed markets, but emerging markets are the ones that are struggling the most. And you can see initially it was that dollar strength, and the dollar giving back a lot of that strength today, not showing up yet in those emerging markets. And just remember, emerging markets over the last so many months, pulled back here to a 9-month period, emerging markets had been doing very well, outperforming even developed markets, and outperforming even IWM, doing very well with the strength in commodity prices, evidenced there by crude oil. But since the dollar took off here kind of mid-April, that little rally you see there in the U.S. dollar, crude oil, it didn't impact crude oil. Crude oil rallied too along with the dollar, and that usually doesn't go hand in hand. They kind of bucked the trend. The crude oil was the one that gave way while the dollar maintained the strength. But now you can see crude oil bouncing and the dollar pulling back. So that's the negative correlation you typically see between those two asset classes. But during that strength in the dollar, it didn't necessarily keep stocks down, but it did put some pressure on them. Small cap stocks leading the way, but you can see it had the impact on gold, and also had that strong dollar had an impact on emerging markets, giving up a lot of its relative gains here with the recent strength in the dollar. And a lot of that recent strength in the dollar coming from relative weakness in the euro, and the euro's weakness is across the board against multiple currencies, not just the dollar. So I think the dollar, the lift in the dollar is actually coming from that weakness in the single currency, and we all know why it's weak. I don't necessarily think there's other fundamental issues here. You still have commodity prices, which are still high and bullish, and you expect them to maintain that strength as we potentially are entering the latter stages of a long-term bullish cycle. And again, those latter stages won't end overnight. They won't end next month. They won't end a couple months from now. But we're heading into that period. We're heading into the later innings of a 9-inning game, if you were to use that analogy. From a sector strength standpoint, you can see where the strength continues to lie. You have the XLK and XLY with bullish postures and rising intermediate lines, again back above the 80th percentile. So very strong strength in those typical leaders. Healthcare and energy bouncing back up today. Energy still showing a bearish posture, but not as strong, weaker, because it's still above the 50th percentile. Above an upward trending moving average. So bounce back up in energy costs. Look at the strength in utilities and real estate today. So interest rate sensitive areas, and look at the little bit of a breakout finally we're getting on staples. It's got that intermediate line that's rising. It's breaking above the moving average, which it hasn't done for a while. So you're finally starting to get some relative strength there in this area that has been so weak for so long. So we're kind of overbought, and we're getting overbought clusters in technology and discretionary, as well as energy, and we're starting to move into some of these areas that hasn't been as strong. Healthcare, materials, industrials is another area I've kind of focused on in the past, and then of course staples, especially being the weakest one, and your interest rate sensitive area starting to pull up too. Kind of remind you on this long-term chart here, set same 9-month period, there's your staples, this orange line, utilities in green, and real estate right here, really, really lagging behind. I mean, all three of them negative for the 9-month period. Stocks are up 12.5% over that period, and those sectors are negative. Whereas your discretionary and technology are your strong leaders, starting to show some overbought conditions. Energy maintaining its strength too and bouncing back up. You can see healthcare and industrials. Here's materials here, industrials kind of matching the market. Those have been laggards and you can see some rotation potential moving in from these areas that have been so overbought and unable to get through those old highs into some of these areas which have been lagging behind for so long that are offering up some decent value compared to some overbought stocks. All right, one stock in that technology sector that's been kind of the reflective of the sector's outperformance and then potential for kind of consolidating is Micron. Micron, you can see, is very, very bullish. It's MACD, not as bullish as it was at the beginning of March, and it really kind of took off here at the beginning of the year. Remember, the stock market peaked in like beginning of January and then really kind of fell off the cliff here. But Micron didn't. It took off here at the beginning of March, kind of led the bounce in stocks, and then has led this current bounce in stocks too. Consolidated when we got about to these levels before, and you can see well up above the 30-day moving average. Again, MACD is very high, which means the 8 is the green line is well above the 17-day. And of course, stochastics already pulling down towards a very high moving average. A lot of volume trading hands, above average volume as we've been pushing up today. Kind of a doji pattern here today. Small little loss, bigger range, and finishing kind of in the middle of the range. When you look at other indicators like the Bollinger Bands, you can see the Bollinger Bandwidth for Micron here is very very, very high, relatively speaking, which means the bands are far apart from each other. And you can see too, after breaching the upper Bollinger Band here, now we're starting. We pulled back initially pretty quickly to the moving average, but bouncing back up off that moving average, and now starting to slowly move our way towards the middle, which would suggest consolidation. Usually happens when the Bollinger Bandwidth starts to shrink and we pull back a little bit. And you can see a similar pattern developing on the DMI as well. The DMI, as high as it is, the positive well up above 40. The negative never did get below 10, but still pretty darn low. Again, relative, very similar pattern to what you had here, opening up the possibility for consolidation. Right, and of course, when you get again, doji pattern today with a big range relative to the ATR, so relatively big range you can see there. So I'm not necessarily thinking that this will drop, but at least start to move. You can see after that big move, we had a expiration or two of consolidation before we had another good move. And so, considering the markets, the rotation right now in this bullish market that's been led, the current bullish posture has been led by technology and discretionary and energy, seems to be shifting from those overbought areas to the oversold areas, utilities, real estate, and especially consumer staples. It doesn't necessarily mean this will go down. This can go up, but it might not go up as much as we've seen some of these indicators suggesting in terms of how bullish it's been. You look at the market forecast indicator for it. Pull up MU. We didn't quite get a cluster here during this little bit of rally, but you can see how bullish we are, and you can see also the divergence is setting up here on the near-term line. Much higher highs corresponding to progressively lower highs on the near-term line itself. So you can say, okay, well, could we do something on here? And you can see I've got a little bit of a setup for selling a call option on the top side. In this case, using the 30 delta for the call, so going a little bit closer, because again, we've already experienced a lot of the upside move, so I don't have to go so far out on the delta on the upside, and then the call side going down to that lower 20 delta like normal. And you can see the setup here with the credit, and if I analyze that, decent odds of success, and as you saw on the chart, there's the break-even level. So there's the high point here. We can continue to blast up through to new highs, but from a low point, you can see the break-even is sitting right at that old high there, Fibonacci, the bottom end of Fibonacci retracement zone. So there's a lot of support that will hold it in this area here, where we can still lock in some gains. It's once you get past here, then we want to take a small loss. But remember, we're trying to get a $564 gain using 3 contracts. That would keep my risk at 1% of a hypothetical $100,000 portfolio. So I'm getting, going for 564 bucks. I can, get to a point where I can end up taking a $564 loss before I get out of this trade, and that gives me some wiggle room. The lines I showed you were for break evens, but here is the kind of a one. Here's the line for a 1-to-1 profit loss ratio. If I were to throw those onto the charts, you can see kind of how. Whoops. Try that one more time. Get to the $564 loss. All right, and about that area, and then over here, right about here. So 1-to-1 loss. And if I set these slices to the charts, which is what I wanted to do, it kind of gives you, there's my wiggle room now to get a 1-to-1. And you can see now that that line is down below the Fibonacci retracement, below that old high, which will act as a support, below what the moving average would be at the time. So a lot of support that can hold it up on the downside here. And of course, definitely some upside risk, but again, we've experienced a lot of the upside already to get to this point that's produced the high Bollinger Bandwidth, the high DMI reading on the positive directional index. So a way to be able to trade the consolidation, a potential consolidation and rotation out of a really hot sector, in this case a hot industry, into underperforming areas where there's some more value, without necessarily saying let's sell and short Micron. It's just a way to say, okay, if Micron slows down, how can we take advantage and still get a pretty decent return on that slowdown? So tell me what you think about today's trade idea. The little pop-up here in the top right corner. We can discuss today's trade idea in the Market Outlook forums. We can also discuss tonight's market posture and any questions you might have in the Market Outlook forums on marketscholars.com. Love to hear your thoughts. Love to interact with you. So let's go over there and see what you think. As always, thank you very much for watching today. Remember on YouTube to subscribe, like, and comment on today's video. Remember, if you're watching on marketscholars.com too, you can also subscribe to our site and like today's video on today's blog post multiple ways, and then finally comment on the blog post too in the Market Outlook forums. So thank you for watching. Have a great evening, everybody. Brandon will be back on tomorrow, and then I'll finish off the week on Friday. So until next time, thanks again. We'll see you then.